All right. Hey, everybody. Welcome to Anderson Business Advisors. Welcome back to Tax Tuesdays. My name is Barley Buller. I'm one of the CPAs here at Anderson. Joined by Mr. Elliot Thomas, the manager of our tax advising department. Tell the people who we are, Elliot.
We are bringing tax knowledge to the masses. That's pretty much what we do, live from, 500 North Rainbow?
That's right.
Beautiful Las Vegas, Nevada.
Live from Las Vegas studios. That's right. Tax Tuesdays, you guys know the drill. We're going over your questions. So we ask you to submit your questions. We do, we go through and we try to look for ones that, maybe that have some crossover. You guys have a lot of the same issues we're facing, right? So try and pool some of those questions together. As usual, you guys know the drill. Let us know where you're tuning in from. Let us know if you have any questions. Shout out any questions here in the Q&A.
And on that, just a reminder, we got the webinar chat. Put in there where you're from, where you're watching us from or hearing us from. But if you have specific questions about, to ask tax related, put it in the Q&A. We got a whole staff there. We got Troy, we got Arash, we got Jared, Jeffrey, Marie, Rachel, Ross, and I'm probably missing some, but that's as far as my list will go.
Holy cow, that's great. So we got a whole team. So in case you guys haven't picked up the theme, we really like bringing this open format to you so you can just kind of ask your questions, get this knowledge built up. We've got the Platinum Knowledge Room, kind of a similar Zoom meeting format with a bunch of tax advisors in there. You can submit questions to the Platinum portal. But today, we'd like to really specifically go over your questions that you have submitted. And let's go ahead and touch base, hop in.
Yeah, we had some Hong Kong, Long Beach, San Diego.
Excellent. Nice. International clients, love that.
Yeah. All right. But the questions, we're getting them from you. Please, by all means, send in your questions. Go through them every show. I go through every one of the questions. Try and get the ones where I'm seeing kind of the same type of question coming up. And of course, if we have some really unique ones, I try and throw those on as well. But we can get those in. Email us at taxtuesday@andersonadvisors.com. We simulate them all, and then the ones that we don't get to on the show, we send to actually our team. In tax advisors, we handle quite a bit of those in our Platinum questions, and if it's something that requires a little bit more in detailed, you might need to be, if your questions today are a little bit more detailed that you're asking our panel, we might have to have you become a Platinum client before we can answer those. And if it's even really more detailed, going to be some calculations and things like that, you might need to be a tax client.
Yeah, fun, fast, educational. We want to give you all the tools we have. If you need specific guidance or calculations, we want to set up a tax call just so we can make sure we're crossing the T's, dotting the I's, right? It's not like we have the answer, we're just not giving it to you. We just got to make sure we get all those pieces. But until then, we can cover a lot of ground just by going over these same kind of questions. Let's hop right in. So we're going to run through the questions real quick, guys, just kind of give you an idea of what we're looking at, and then we're going to go through, pick these apart, go into a lot more detail. When a house is under a transfer on death title, that sounds like something to do with taxes, doesn't it?
Exactly.
That sounds very tax related. When a house is under a transfer on death title, do the beneficiaries still get a step up in basis? Ooh, that's a big word, isn't it? Stepped up basis. That can be a huge deal. So we're definitely going to be addressing that.
If I already qualify as a real estate professional, rep status, via short-term rentals and add long-term rentals to the mix, can I can I lump the two kinds together? And does having an S corporation that manages everything affect my rep status?
Yep, we talk about that a lot. Certainly going to be going over that. Where real estate properties are in individual LLCs, disregarded and owned by my C corporation, does the C corporation maintain one bank account and collect rent for all individual properties? Right, so using a C corporation for management to preserve the limited liability in the LLCs. How do we use a management company without losing liability protection, right?
Because that's why we set it up in the first place. So we definitely want to have that clear.
Right, definitely want to
have that. But it all
that.
comes down to tax in the end when we shake it out. If you get started in wholesaling, should you file as an S corporation?
You'll hear that a lot. We suggest setting up a corporation. We'll go over that. Explain thoroughly 280A. This is low-hanging fruit, right, guys? This is an easy way we can pull cash out of the corporation. We're going to just do a full deep dive on that. You're going to know every single step. You have to know. It's really not that much.
No, not a whole lot.
It's not a lot, but
all those steps, you're going to know them.
Yep, you got to know, but you got to follow each detailed step if you want. That last step is that big fat check in your pocket, tax-free, that you don't even have to report, right? We love that.
That's the win.
Bookkeeping.
What kind of bookkeeping is needed for rental real estate? Do you have any bookkeeping softwares to suggest? We might need some help on that one. We'll see.
Yeah, we might need to call in the pros on that one.
Yep.
But it does all start with bookkeeping. Great question, because that is what starts our fundamental knowledge of this whole this whole journey into tax and accounting.
Otherwise, your taxes could be off and you're not paying enough.
Right.
If your bookkeeping wasn't good.
Got to be more patriotic than that. Let's hop right in, guys. Any comments or questions you want to address before we hop in?
Not yet. I think the team's getting them so far.
Excellent. All right. So when are we starting off right? Let's see.
Yep.
When doing an IRA to Roth conversion, what are we talking about there? Traditional IRA versus Roth IRA, right? We can convert a traditional to a Roth. That's a taxable event, though, right? Okay. So when doing an IRA to Roth conversion, are there any limits? I'm assuming we're talking about dollar limits here. Are there any dollar limits? How much can we convert? Are pre-tax conversions always treated as ordinary income, right? We have ordinary income, various forms of income. Part C, is it true that the IRS does not know or care when the conversions were done during the year? Great question. A couple moving pieces to that. Is it true that a withholding payment to the IRS will trump all other forms of payment? For example, quarterly estimated payments, another great question. If so, as a small business owner, can I just issue myself a payroll check at the end of the year that withholds enough to cover all conversions for the whole year without penalty for not doing quarterly estimated payments? Bunch of great questions there. Let's hop in.
And then how does tax work if a business owner is paying himself as an employee? Do we have to tax twice, once for the business income and once as an employee payroll taxes?
Right, definitely want to look at that. How do I do a 1031 exchange? You're in the right place here.
And how do I maximize real estate property depreciation after I do a 1031 exchange? Am I stuck with the previous depreciation rate and amount of the previous property?
Yeah, very powerful tax tool. Certainly going to be going over that. Yep. Guys, make sure you subscribe. We mention this a lot. So much good content. Oh, we've hit 1,000 videos. Woo! Where's our...
Yes. Well done.
Good work, Mr. Mathis. So stay up to date here, guys. Obviously, tons of good tax and asset protection, tax planning, tax planning on more on Toby's side. Also, so many good industry interviews, captains of industry being interviewed there. Just a bunch of great material on there. Clint obviously focusing more on the asset protection side. Bunch of good information there. Make sure you tune in. What do we got here?
We have our event coming up in Las Vegas, June 26th through 28th. $99. Hit the little code thing there and join us live. This is our regular TAP event. Well, not regular in that it's in Vegas. That's pretty cool.
Right.
But great time to come and meet everybody, meet some of our staff, meet other clients, meet new clients who have a lot of experience all across the board. Great networking, great ideas, just flowing back and forth. Everyone who goes there, I've never heard anybody say, wow, I didn't enjoy it.
Yeah.
They just sit there and really have a good time. So we're looking forward to it.
Event.
Again, 26th through 28th. And I think it's at the new Durango.
Oh, nice. Yeah, and come see all the new development in Las Vegas. Wow, the city is really taken off. And tax and asset protection workshop, of course, going over the basics here. May 10th is our next?
Yeah, we're going to have the May 10th event. And the May 17th, those are typically online events. And then, of course, the big one live here in Vegas, 26th through 28th.
All right, guys. Ready to talk tax?
Yeah, let's do questions.
All right. When a house is under a transfer on death and taxes, the inevitable subjects, let's go ahead and just breach these two subjects here. When a house is under transfer on death title, do the beneficiaries still get a step up in basis? That's a pretty big deal. We want to know if our beneficiaries are getting a step up in basis, right?
Yeah. We probably want to know what transfer on death is.
I have no idea.
That is something unique to certain states. It's about half our states have it. It's a certain mechanism by which you can just have your property go straight to the beneficiaries and avoid probate.
Oh.
You'll often hear Toby talk about it, Clint, Michael Bowman, all of our partners talk about that, how expensive probate can be. Someone passes away, it goes to probate, the attorneys are taking a big chunk out of that. Well, maybe through something like transfer on death is a way you could get a property, a house, to move without having to go through probate. Better than all that, why don't you use a trust, a living trust or something like that, and avoid all that probate. But transfer on death is a specific thing. Approximately, again, 27 of the states, I believe, have adopted it. And it's kind of a unique provision in that it wasn't done like, for instance, we have community property states or non-community property states. Those kind of go by regions, your West Coast on down through the South. This is something that's kind of dotted across the whole U.S. Some states have this transfer on death, some don't. So you got to know your state that you're in, or better yet, just get the living trust and avoid it all. But the big question here from a tax perspective, are they going to get the stepped up basis? Yes, they generally will. So in other words, I pass away, I leave my house to Barley, he's going to get stepped up basis immediately when I die. Nevada is, by chance, it just so happens, a transfer on death title state. It has it available. But if I made that provision, then it would go straight to him, it avoids probate, saves the money, keeps the attorneys out.
Excellent. Now, like Elliot mentioned, you'll obviously want a living trust. We're the kind of more debits and credits tax CPA side. Talk to your attorney about a living trust. That's one of the more common asset protection, or excuse me, legacy planning tools.
It definitely encompasses a lot more.
Right.
A lot more moved over, avoid that probate.
Yep. All right. Let us know if you have any follow-up questions on that. Step up in basis, that's crucial. We wouldn't want to do it if we didn't get a step up in basis,
let's go with it. What is the stepped up basis? How does that help us?
Right. Great question. So when we typically upon passing, right? We see this a lot with an inheritance. When we pass away, we pass on assets to our heirs. When we pass and our heirs inherit our assets, they get a stepped up basis or step up in basis. That's where we'll most commonly see it. Why is that such a big deal? If your parents bought a property way back in the 80s or 90s or something for really cheap, and they instead of giving it to you at their historical basis, what they paid for it, you can inherit it at the stepped up basis, which is what? Fair market value, meaning you could turn around and sell the property for probably no taxable gain, and that's the real big deal here.
Yeah, just a real quick example. Barley buys a house 10 years ago for, let's say, $100,000. Now, if nothing else happened, and let's say before he passes, he gives it away to someone else as a gift, they're going to get his original basis.
Even to my heirs or kids.
Correct. Yeah. As long as you're alive still, when you gave that gift, they're just going to take that same basis. So they have very little to depreciate if they're going to, let's say, turn it into a rental or something of that nature. But if we wait till Barley passes and then they inherit, they're going to get the stepped up basis to whatever the fair market value is at the time of death. So maybe it's worth $500,000 now. They'll take it on at $500,000, and that basis is so critical because if you ever sell it, we subtract the basis from the selling price. That determines your capital gain, how much tax you're going to pay, or if you turn it into a rental, how much you have to depreciate.
Yep.
Boy, do we talk about depreciation a couple of times, huh?
Yeah, I was just going to mention that's going to calculate your depreciation expense off that larger number. It'll give a lot larger depreciation expense, lower taxable income, right? We just follow the tax chain.
All right. Only we could take that question and turn it into 14 minutes.
Yeah, it's only talking about death and taxes. We can really go deep on that, guys. Yeah. Let's see. If I already qualify as a real estate professional, rep status, right? We talk about this a lot. Real estate professional status via short-term rentals. What's wrong with that sentence? It's a short-term. We're going to have to dig into that one. And add long-term rentals to the mix. Can I lump? All right, pepper it together. Can I lump these two kinds together? Kind of, maybe. And does having an S-Corp that manages everything affect my rep status? Not in the vast majority of cases. Let's pick this apart. Okay, first of all, rep status. What are we talking about? We're only talking about long-term rentals when we talk about real estate professional status. This short-term rental, that term is kind of a misnomer. It's really a short-term business that we actually just happen to be renting out to people on a nightly basis or whatever the case may be, like a hotel. We don't call a hotel a rental, it's a business. It's kind of seen in the same kind of light. So rep status is going to be achieved by working on real estate activities in general, but because of this little classification, short-term rentals aren't technically considered real estate, more of a business, so we can't get rep status working on short-term rentals. And I'm probably not explaining it as articulately as I could be. But just want to clarify, because right off the bat we said, can I qualify as rep status via short-term rentals? The short answer is no, we can't.
Right. Your short-term rental, again, average stay, 7 days or less is that. That's our quick litmus test. Yep. Anything else would be long-term. And just as you said, short-term rental is going to be like a hotel. It's going to be an actual business is how the code looks at it. Whereas that rental activity, long-term rentals, the key here is that that's usually what we call passive state.
Yep.
Well, if you have real estate professional status, that's going to change it to active income, and we might have some tax benefits down the line from that. But quickly here, again, short-term rentals, you're not going to get short-term rental activity that's going to allow you to have real estate professional. What you can get is what we call material participation with a short-term rental. And that just means that you're putting more time in than everybody else. Typically, that's the quick answer, but a couple tests out there. One is over 100 hours more than anybody else. You're directly managing it yourself. or over 500 hours. Those are the two most common tests we use.
Yep.
And when we get that, then it's no longer a passive activity. It becomes active, and we can do some things with depreciation, create some losses perhaps. Those losses are now ordinary and will offset any income that we have on our return. But we're not going to get there through real estate professional status because they're short term. But we do have maybe a little fix that we could do and maybe denature that short term rental. What do we got going on there?
Right, so yeah, a kind of a unique exception. So let's say you're managing several long-term rentals, you have real estate professional status, I'm going to throw in a tax term here, you've aggregated those rentals together. Now let's say you want to add another short-term rental that's not part of that mix. But I have real estate professional status, I might want to do a cost seg study and take some depreciation from there and offset my W-2 income. How can I pull that into the rest of this pool? We can do what we call a master lease or a long-term lease through a corporation. Won't go too far into the weeds on this today, guys, but essentially if that's you, if you have this pool of long-term rentals and you're adding a couple short-term, you want to pull those benefits into your real estate portfolio, there is a way we can do that. We call it a long lease through a corporation.
Yeah, we just basically, the corporation rents it long-term from us. It's our house, short-term rental, but it just takes a year-long lease, and then it subleases it out to the general public for the short-term rental activity. And that way we can, because you talked about the aggregation, that could pull that property all the way back in to the rep status, and we can get what you want as far as your tax status. So can it be mixed together? Not without some help. We got to add some other ingredients in there, C corporation, master lease, some of those terms. And then maybe we can get to this spot where we have them all in there with the real estate professional, get all those great benefits we always talk about. Does having an S corporation manage it, is that going to mess with the rep status at all, you think?
Not necessarily. We want to be careful here. So we're assuming that this is an S or C corporation that you own and control. You're greater than 5% owner. That's going to be the vast majority of our clients. If you're a fractional owner in Coldwell Banker or something through a separate corporation, those hours would not count towards your rep status. I'm almost certain what you're talking about is I have my own S-Corp managing the rentals. I'm likely the 100% owner. Those hours will count towards your real estate professional status, not the material participation, but we get those real estate professional hours through our corporation, absolutely.
Yeah, and if spouse, a spousal situation where you're both shareholders of that S Corp or C Corp, then you consider your time and your ownership together to get to that 5%, at least for the material participation. Rep status, though, we would have just one that we'd be wanting to get all those hours, just one of the spouses. But yeah, so
rules.
Can it? You're right. Does an S corp having an S corporation as a management corp, does it necessarily hurt anything? No, but we just want to be careful, and you would want to sit down and map this out with one of us, tax advisor or something like that, some professional who understands some of this. But the quick is that on its own, no, you wouldn't mix the short-term and long-term rentals unless you take some of those strategies that we talked about. Then we could put them together, and the management corporation, as long as used applied properly, you could still use that too, and it should not negatively impact rep status.
Right. Yeah, and using a corporation, that could likely be very much to your benefit. Likely would be recommended if you have some investments to manage there.
Yeah.
All right. Let us know if you have any follow-up questions on that. Great question. All right, what do we got going on here?
Where real estate properties are in individual LLCs, that is disregarded, and owned by my C corporation, does the C corporation maintain one bank account and collect rent for all individual properties and pay expenses to preserve limited liabilities in the LLCs? So we got a bunch of LLCs. We're saying they're owned by our C corp. We say they're collecting rent from those properties that are in those LLCs. Any thoughts on that?
Well, the first thing we got to throw out, obviously, is the holding real estate in a corporation. Appreciating real estate, we generally recommend not holding in a corporation. Not to say that there aren't times you do it. Flipping, wholesaling real estate, we would generally see that through an S or a C corporation. So just want to throw that out there right off the bat. We kind of want to distinguish, are we using the C corp to manage, or is the C corp the owner, right? That's going to be a big distinction. Yeah, very big distinction we want to make here. You state it as they're owned by my C corporation. So there's a couple ways we could look at this. Let's assume these are flip properties held in disregarded LLCs, right? That sounds good to me. Got flip properties down to the C corporation. The C corporation can have its bank account. You'd likely want to do a bank account for each LLC, even if these were flips.
But you could get away with the one, though.
You could get away with the all-in-one account there. Yeah. Well, and then you mentioned collecting rent. So now I'm thinking these probably aren't flips. But just for illustrative purposes, we can hold real estate. It's called inventory, really, when we're talking about flip and wholesaling properties in LLCs disregarded to a C corporation. But I have a feeling we're talking about rent here. So we want to first look at that, right? First, talk to your advisor or talk to one of the attorneys about your kind of structural setup. Make sure we're on the right page there. But as far as one bank account collecting rent for all individual properties, the main thing I think, at least the thing that first pops out to me is maintaining our liability protection. We got to kind of maintain our asset protection. We need to treat these like separate individual projects so that the courts also do, the potential creditors also do, the bankers also do.
And one of the ways we do that
is through the bookkeeping.
Exactly, and bank accounts and
Yep.
things like that. So to kind of sum this up, we would not recommend a C corporation owning a bunch of rentals in LLCs that it owns. We probably have a situation where a C corp should be managing those LLCs. It can collect the rents. That's part of its management function. It pays out some of the bills, releases the rest of the funds, because remember, it doesn't own the properties. So that rental income doesn't belong to the C corp, but it sends it back. That's part of its job. It can earn a management fee. Very common structure we work with all the time. And yeah, we recommend in that case that each LLC have its own bank account. There's good, better, best. That would be best. But as long as we have good bookkeeping that independently breaks out those LLCs and tracks what's going on in each and one of those rental properties, and of course the C Corp too, that would need its own books. As long as we have that all going on, then you could probably get away with maybe one bank account at the holding company. All these LLCs have them owned by one holding company in Wyoming is often what we'll do. And then offset over here, we'd have our C corporation unrelated to any of these rental properties, but managing them. And there we would have a bank account in our C corporation, one bank account in our Wyoming holding. We could probably get there, that'd be good. But best would be have a bank account in each entity.
And I say this a lot, guys. Think of this as just a traditional property management relationship, right? If I buy a rental and go hire a third-party property manager to manage that rental for me, just think of it in that exact same way, right? They're just going to manage the property, collect rent, send you the balance. Most of that kind of paying the bills, that's going to be all that out of that LLC account.
Yep.
Right? Typically, your property manager is not paying your property taxes and mortgage interest and things like that for you in most cases, right? Just think of, if that helps, think of it as just to help delineate some of those functions. Traditional property manager, your personal investment is the rental LLC. The property manager is the business managing the asset.
All right.
All right. If you get started in wholesaling, I kind of started down this road a little bit.
Yeah.
If you get started in wholesaling, flipping, roughly synonymous terms here, wholesaling, flipping, should you file as an S corporation? What say you, sir?
Well, first of all, wholesaling, what is it? It's basically where I go out, I look for a property, maybe it's a distressed property, I have a seller who's really excited, really wants to unload this thing. I can get it under contract and then immediately sign the contract over, or we can do a double closing all at once. But really, I don't ever own it for too long or just a brief period of time. So I sign the contract over. I take part of the profits for doing that from the ultimate buyer. That's wholesaling, where again, I'm not really flipping. I'm certainly not holding it to rent or
kind
anything.
Kind of a middleman.
Like yeah,
of sorts.
exactly. You're just there in the middle, trying to meet between a seller and a buyer, and be that bridge between them, and take a cut of the action for it. That's an active endeavor. So when it's active in the case of taxes here, that means that it's not just going to be subject to ordinary tax rates, meaning we don't get capital gains treatment, but it's also going to get hit with employment taxes. So we're really throwing the taxes on here. So we do really recommend that you do it in an S or a C corporation, because there's a lot of goodies there, some benefits that we can do, some reimbursements, accountable plan, corporate meetings. We might even be able to change how much we pay as a reasonable wage out of our S corporation, so we have less employment tax. There's a lot of good benefits. So yes, we certainly recommend doing it in a corporation, S or C. Also, if you have a repetitive activity or something like that, wholesaling being akin to flipping, you might get something like dealer status, or perhaps which can have a negative impact down the line in your investments. So yes, should you file as an S corporation? Well, I'd say S or C. I think you're good. Or, and again, these always include LLCs taxed as S or C corporations.
Yep.
Yeah, I think we'd be good with that.
Yep, good work. All right, let's go through thoroughly explaining the 280A process.
Never talked about that before.
Right, this one comes up a lot, doesn't it? So first of all, what is it? You hear it called the Augusta Rule, the 280A rule. You hear it called the Augusta Rule for Augusta, Georgia, the Masters Golf Tournament. That's the origin story for this piece of legislation, this piece of code. The deal is the Masters Golf Tournament, this big golf tournament happens every year. The poor little town of Augusta, Georgia gets descended upon by hundreds of thousands of golf fanatics, and the people that live there are like, we got to get the heck out of here.
Right.
And they're kind of, they're not forced out of their homes, but they kind of are.
They kind of are.
Their town gets invaded for a week, and they got to get the heck out of there. You can't blame them. So the IRS gave them a break. You know, if you live in Augusta, Georgia, bummer, right? Live in paradise. Well, you get a break if you rent out your house for less than 2 weeks. So this could apply to a bunch of different kind of situations, right? As long as it's less than 2 weeks total. What we're talking about here is types of income we need to exclude or include in when we're talking about rental activities here. So 280A rule essentially says if we rent out our home for less than 14 days, we don't have to include the income. So that's the background. Give us a little more on that.
Yeah. So 280A is just a code section that says it really is meant to prevent you from taking deductions on your personal residence, or what we call a dwelling. If you stay too long in a house, the government doesn't want you deducting your personal expenses on your living condition. And so 280A is really a restrictive provision. There's two common used areas where exceptions to it. One is if you have the home office or administrative offices, we often use it. Well, then we might be able to take some deduction there, given that all the boxes are checked and things like that. And then we have the 280AG, which is the idea that you can rent out your home for 14 days a year, no more, and the income that you receive is tax-free. Now, we often bring it, a long time ago, Toby wrote a white paper about this, about how we can use it maybe for a corporation. A corporation's often required to have meetings, your C-Corps, your S-Corporations. Well, why not it be the one doing the renting? It has a meeting in Barley's house, pays Barley $1,000 for each meeting. It does it 14 times a year. As long as he doesn't rent out his house again, that's tax-free. He pockets $14,000 tax-free, and the corporation gets to take it as a deduction because it's a meeting expense, reasonable meeting expense, ordinary business expense. And so we got a deduction at the C-Corp level. We got free cash to Barley to the tune of $14,000. It's a win-win. Now, there's a lot of little things there behind that $1,000 that I just throw out there. How are we going to determine that $1,000? Where are we getting that number from?
Yeah, great place to start. So to substantiate this deduction, and again, like I started off saying, this is an easy one, guys. If you have an S-Corp, you set it up in 2025, and you've already made a good profit, and you don't have an accountable plan in place yet, and you're not renting out another room in your house, you can sign this template and set up these 14 meetings for the rest of the year. This is an easy one, and the only thing we really need to do, well, the first step to really substantiate the deduction, get 3 quotes. Called up the local hotel. Just like Elliot said, why pay the Hilton $1,000 to rent their conference room? Write that check to yourself. You don't have to report it. You don't have to pay taxes on it, and you can do it again next year, and the year after that, and the year after that. This is a great way to pull cash out of your corporation. So the 3 quotes, make them official, right? Make them look, if you can, make it look like an invoice. Tell them, hey, I want to rent a conference room. Can you send me a sample invoice, or at least an email or something? The more official you can make it, the better. 3 of those. Take the average. That's our annual expense right there. That's the end of the road for the calculation as far as that's concerned, how much we're going to charge. Then we just write up a simple kind of invoice from you to the corporation. The corporation deducts a meeting expense deduction on its profit and loss. What kind of agreement do we want to see there?
It's really just, we have a 280A kit out there that back there in the back of the form has just an agreement that, it will be $500 or whatever amount you determine for however many meetings you do. But just a very basic, simple kind of invoice saying, hey, today's May 6th. ABC code, you had a meeting in my home. We agreed it'd be $500. Here's an invoice. Put that in the the bookkeeping. Always got to use that bookkeeping.
Yep.
Put that in the bookkeeping for your corporation, S or C corporation, LLC taxes and S or C can all take advantage of this. And then that's going to get you your amount. But we also, the corporation must, this is critical, corporation must cut you a check or transfer online the cash. It has to pay it if it's going to get the deduction, okay? And you certainly want to receive it if you have the free cash.
Right.
So we got to have that transfer ideally before the end of the year, but you know, there's a lot of different rules we won't get into today, like if it's something that happened on the 31st or whatever, cash basis rules. But the bottom line, get the quotes. You only have to get 3. Okay, we'll use those for the whole year. You don't have to get 3 quotes for every meeting, and then the next year go out and get 3 more.
So, thoroughly, explaining thoroughly. So, we're going to apply this to S or C corporations, generally not to sole proprietors or partnerships. It's not that you can't do it there, but that the guidance we offer is generally for S or C corporations. Make sure you're not renting another room in your house. Get your 3 quotes and take your average. When we say upload a copy or keep the invoice, or all we're talking about is Box. Right, upload it to Box. That's your permanent digital storage. Right, that's where you're going to put your invoices, your quotes, your your invoice to the corporation, etc. So, what else?
We got the amount. Make sure it pays it.
Yep. Write the check.
Yep.
Yeah. So from the very last step, we get a check or ACH or whatever in our pocket that's tax-free that we don't have to report. Right. How do we substantiate that? We have to have the corporation actually write a check or make the transfer. That justifies the corporation taking the deduction on its books. Remember, this is a double benefit. The corporation is going to write us a check for $12,000 or $14,000. That's a legitimate business expense to the corporation, lowering the taxable income, lowering the amount of tax we have to pay at the corporation. Benefit 1. Then we get a check in our pocket that's tax-free that we don't have to report. So it's really a double benefit there. Oh, I'm sorry. The last step to that, you have an S or C corporation. You're going to sign an accountable plan template. We have that available for you. The IRS just simply says you need a reasonable plan for reimbursements in place. Put a signature on that accountable plan template, upload it to Box, then you're good to go. So you got your accountable plan signed, you got your quotes, you got your invoice to your corporation writes you the checks, and you don't do anything. You just take the money.
Yeah, that's 288.
That's 288. I can't think of anything else to add in there.
Yeah, that's about as thorough as we can get.
You can still do it with a home office. You just, technically speaking, you aren't including the exclusive use portion of the home for the home office in the 280A. You're renting out the rest of your home for the 280A. So that's not even a concern. You can still get the home office deduction and 280A.
Yeah, the accountable plan really goes more to the office because there it's a reimbursement.
Right, thank you.
280A, it's really not a reimbursement. It's actually rent. It's rent. You don't have to
We just don't have to declare it. Yeah,
yeah, it's a good deal.
Yep.
All right, I think we beat that one.
All right, we got that one. Let us know if any. I hope there's no questions on there. Hopefully we got that thoroughly.
Uh-oh. Speaking of bookkeeping.
Ooh, I think we might need to call in.
Yeah.
We might need to throw in a lifeline for this one.
Yeah, what kind of bookkeeping is needed for rental real estate? Do you have any bookkeeping software to suggest?
No, but I have a bookkeeping
professional. We know a guy who knows a guy.
I know a guy that knows a guy.
Troy, you there?
Hello, can you guys hear me?
No, we can't.
Oh, man, I have a feeling a lot of the people in the crowd are familiar with Mr. Troy Butler.
Yeah.
Hi, Troy. Thanks for hopping in today. How are you, sir?
Of course. Good. You guys are doing great so far.
Very much appreciate your help.
No complaints in the Q&A, so that's good.
Yeah, that's a first.
That's good.
Well, it's good to have a victory.
So Troy,
bookkeeping.
Yeah, and I just want to throw this out before we hop in. We do have a bookkeeping open office hour in the Platinum Knowledge Room is it Thursday from 1 to 2 p.m. Pacific?
That sounds correct, yep.
Right, and so you may have seen Troy in there, but yeah, where do we want to start on this? I got some rental properties. I know I have to do bookkeeping because that's the foundation of all my efforts. Where do we even start with this? Do we look for software? Do we call Anderson? Do we talk to Troy? What should we do first?
Sure. So there is an IRS requirement that you do have some form of bookkeeping, but what the IRS tells us isn't very clear as to what that bookkeeping needs to entail, right? So do you have to have software? Can you just have a box of receipts? Whatever. They don't really specify. But what we at Anderson, we use QuickBooks Online specifically as our bookkeeping software. But there are thousands and thousands of other softwares out there. Stessa has some bookkeeping functions built in. Stessa, fun fact, is asset spelled backwards. So that kind of blew my mind the first time I learned about that.
And that's rental specific kind of?
Rental specific, yeah, that's for like property management kind of companies, landlords. There you go. ZipBooks is another one. Xero with an X, Xero. That's another good accounting software. But fun fact is they all kind of do the same thing, right? And they all have different looks, but they all end up creating the same thing. It's really just user preference. The reason I like QuickBooks the best is because if you ever run into a problem, you're not the first person to run into a problem using QuickBooks. There's thousands of forum posts, YouTubes, goes on and on for the support for QuickBooks. So that's what we usually recommend. But then, actually taking care of your books, just buying QuickBooks isn't going to be enough. You're going to actually have to use that QuickBooks and input the income and the expenses, right? If you just want to keep track of your income and expenses, you can always use something like Excel. It's not going to be pretty. It's going to be a lot more work, but you could use Excel. But QuickBooks has, and all the other softwares that I mentioned, have some sort of function. In QuickBooks, it's called classes and locations. So you can set up a class for each and every rental property you have. So you're keeping track of each rental separately. So that becomes very important when you're trying to do your taxes, because we have to report it by rental. It helps for planning, because if it's all jumbled together, it doesn't mean a whole lot. You don't know how each property is doing. And three, that make sure that you're not commingling funds, right? Like if you have an LLC that owns one property and an LLC that owns another, the two aren't commingling. So any other questions on that?
So price is always an issue. I know that's not really the topic today, but QuickBooks is just so expensive, right? Gosh, is anyone competing with them that offers a similar service? I know it's kind of off topic, but
the ones I mentioned, they're a little cheaper than QuickBooks. QuickBooks
Xero
is kind of
decent, right?
Yeah, it's all kind of pricey, and the kind of crappy part is QuickBooks used to offer a desktop version, which you could buy at once and have it forever. They don't do that anymore. It's all subscription based now. So that's the way the world's going. Yeah. Right. The one other thing that I would mention is we do have a bookkeeping department here at Anderson that can help you with all of that. Reach out to your advisor if you'd like to hear more about that. We have a bookkeeping essentials product, which is very good. Highly recommend. And yeah.
One last question for you, sir. So, as far as you mentioned the desktop version, and probably most people this is what they're using, but with the virtual QuickBooks, for example, with the QuickBooks, what they call virtual online, QuickBooks Online, that allows you and your bookkeeper to kind of collaborate virtually. I like that feature. That's certainly kind of probably one of the benefits of not having the desktop.
Yeah, that's a really good point, Barley. Back in the olden days when we had desktop, we had to send files back and forth. We don't have to do that anymore, which is a big benefit.
Right. So you can go in and see the adjusting entries your bookkeeping team is making, and awesome. Well, thank you so much, Troy. And again, Thursday from 1 to 2 p.m. Pacific, open bookkeeping office hour, plus platinum questions, right? We get our own bookkeeping kind of platinum question.
Absolutely. Lots of different ways we can help you guys.
All right. Well,
sounds good. Thank you.
Now it's on you,
Good luck
team.
the rest of the
Take
way.
advantage of it. Thanks, Troy. Appreciate the time very much, sir. Thank you. Yeah, so there it is, guys, the bookkeeping. That's the scaffolding of our operations. It really is. For example, we take like our profit and loss statement, a line item like dues and subscriptions or something. We want to be able to look at that line and kind of just have an idea of where that number came from. It says dues and subscriptions $1,000. We kind of, that's going to include my monthly platinum thing, maybe some trade publications that I subscribe to, or my QuickBooks Online or something like that. We just kind of want to have an idea. The bookkeeping, understanding the bookkeeping will give you a much clearer idea of how all that stuff is constructed.
Yeah, the bookkeeping, it's the foundation to everything. If you don't have good numbers, your tax plan's out the window. Just as importantly, your management's out the window, because you don't have any idea if that rental is making you money or if it's costing too much, or why is water so expensive on this unit versus the other unit. Good bookkeeping keeps it all organized, helps you make better decisions, and certainly helps you from a tax aspect.
Yeah. Sounds kind of nerdy, but a well-prepared set of financials is a very empowering thing.
Oh, yeah, absolutely.
Right, a profit and loss statement, balance sheet, general ledger for each of your investments, because we can really zero in on profitability, just like Elliot just mentioned there, profitability, cash flow, right? These are things are crucial to maintaining an ongoing enterprise. We're maintaining an ongoing business, even if it's just a collection of rentals. That's our business that we have to keep going, and cash flow is king.
Absolutely.
All right, what else we got here?
We got a reminder, something's going on in June. June 26th and 28th.
Sounds like a nice time to be in Vegas.
Only $100.
Dang.
Can't beat it. Our TAP event live here. Please, by all means, join us again. A great event.
No, 26 to 28. That sounds like a weekend.
Well, it usually is. I would think so.
Yeah,
And it will
so
be for somebody
you
down
know
here.
what that means, guys. We went over this last week. Book your travel Monday, Wednesday, and you got those business days. That's a business trip. We can write that off.
Yeah, well, there's some deductions to be had.
There's deductions to be had. There you go. And of course, the tax and asset protection. Just reminding anyone that came in late, we got these great workshops coming up.
Yeah, this Saturday the 10th, next
Yep.
Saturday, May 17th, it's going to be our online version of it. And again, as we just saw, 26th through 28th, the live down here in Vegas.
And just as a reminder, if you want to scan this code and set up a session right now, you can. This is, we love this format where we get to go over all of your general questions. And I like to remind you guys, if any of this is obviously if it's specific to what you're doing, please submit a Platinum Portal question, set up a tax call, take the next steps to really drill down on this, because we could go into way more detail on all these subjects, right? It's just, it gets pretty heady, so we want to just give you the tools that we hope will add the most value as we can here and now, and you can let us know what kind of guidance you're looking for there. But yeah, meet with the tax team, schedule a strategy session. It's a great way to get started.
Pull it all together.
That's right.
All right.
All right, you ready to dig? Here we go. We got a
We got about 4 parts here.
Yeah, 4.
And just so you know, normally I won't pick ones that have multiple parts like this, but
Yeah.
it was really a nice way it flowed through.
Yeah,
so.
it's 4 parts, but it's really like 6 or 8 issues that
Yeah.
are crucially important. So let's hop right in.
Want to read it?
Sure. When doing an IRA to Roth conversion, so a traditional IRA to a Roth IRA, Senator Roth, who named us for, are there any limits, dollar limits? How much can we convert? Is basically the question there, right? Are pre-tax conversions always treated as ordinary income? Great question. Is it true that the IRS does not know or care when the conversion was done during the year? Is it true that withholding payment to the IRS will trump all other forms of payment? We're going to talk about estimated and quarterly payments. As a small business owner, can I just issue a payroll check at the end of the year that withholds enough to cover? Right? We talk about maybe I'll just issue myself a bonus and withhold a bunch at the end of the year. Will that avoid all penalties? Maybe, maybe not. We'll talk about that without penalty for doing quarterly estimated payments. All right, let's hop right in. So first of all, are there any limits when we're converting a traditional IRA to a Roth IRA? So what are we talking about here? If your AGI, your adjusted gross income, is too high to make a Roth IRA contribution, you may have the option of doing an after-tax contribution to a traditional IRA, then converting that to a Roth. Right? That's a taxable event, but then we can start building, the Roth can then grow tax-free. A couple considerations we want to look at here, but that's the background. So that said, are there any limits?
Yeah, so anytime, even, we do make that, again, IRA, you put funds in, you got a deduction for it typically, okay? And now you move it into, but it's going to grow, and when you finally take it out, you get taxed. People want it in a Roth, because a Roth, you don't get a tax benefit for, it grows tax-free, and at retirement, you take it out without paying taxes. So that's why people like to get in there, if they can. But are there any limits? No, on an IRA to Roth conversion, now we're not talking about a back door here, but an IRA to Roth conversion, there's not any limits, because the government's going to get its money, okay? It's going to be able to tax you on this. It's a taxable event. So $10, 10 million, they get a big chunk of change coming into them, so they're happy with that. So they're not going to place limits on that. There might be limits to what you want to do from a tax planning perspective, but from the government standpoint, no, bring it all in. We'll take that money. So no limit there. Part B, are any pre-tax conversions, or are pre-tax conversions always treated as ordinary income? Yeah. Yeah, there's no capital gains going on here. That's one of the things. Well, hold on. I'm invested in Bitcoin inside my plan or in stock. It's growing. If I had sold that personally, I'd get capital gains. Well, but you don't in a retirement plan. It's all ordinary. So we don't have that distinction between ordinary or capital gains. So it's all ordinary. Part C, is it true the IRS does not know or care? IRS always cares, I'll tell you that right now. When the conversion
They're
was
just a caring bunch.
Right, exactly, a lot of care. Do they care when the conversion was done during the year? In other words, if I do the conversion in December, will I be treated as if I just had received that income in December as opposed to January? And why do we care? Because the government looks at when you earn each dollar through quarters. So if you've done it in the first quarter, you might have to make estimated payments during the first quarter for income earned during that quarter. Whereas if you did it in the fourth quarter, maybe you only have to make contributions for the taxes for anything earned in the fourth quarter. The problem here is that the IRS does care. And they look at, if you did, let's say you have a conversion, let's say you have $100,000 that you converted of taxable income, they're going to look at it as if it was done evenly throughout the year. That means some first quarter, second, third, and fourth. So if you wait all the way to the fourth and don't make estimates, you're going to get hit with some penalty. Now, even in the fourth, if you made enough to cover the damage, so to speak, of all quarters, it's going to be limited, but there's going to be some. There's going to, especially if you do a really heavy amount of income coming in that fourth quarter. So in this particular time, this particular event where we're doing a conversion, it does matter, at least it's going to be treated as having been done throughout the year. So you'd like to make some first, second, third, fourth quarter estimated payments, et cetera. However, is it true that a withholding payment to the IRS will trump all other forms of payments? In other words, quarterly estimated payments. What the idea of what's going on here is, what if I paid myself in a business as an employee? And they're saying, I'm just going to make let's say I make $500,000 and I pay myself a really large wage in the fourth quarter, and I do a lot of withholding, maybe $300,000 worth of withholding tax on that. Will that go all the way back to January and cover that conversion I did in December for that time period that's being held over the whole year, treated as having been done over the whole year? It actually probably will. It's not a strategy. It's not something that you can rely on.
It's
not.
That's a good point.
It is not in the
strategy.
code. Yeah, it's not in the code. That you can do this and don't worry about it. So if the IRS ever did, let's say they finally got their computers updated, something a little bit more timely or whatever, they may be able to track that, and they would see that you didn't make that payment, or that was for a different type of income, et cetera. It could be. So it's not foolproof, but it is. Well, I just said it's not a strategy, but it is a technique that people have been using.
Yeah.
But we can't guarantee that it'll always work.
Right.
Okay. But a lot of times people do this when in a jam,
Yeah.
and they do that to try and cover that payment from back before, and it typically does work. But I can't promise you.
Yeah, the IRS has this wave their magic wand thing with we're going to annualize the income. We're going to look at the quarterly income. We're going to go look at this year. We're going to look at last year. And then poof, here's how much more money we want. You're asking the right questions.
Absolutely, yeah. And so that's why towards the end here, they're just saying, yeah, I could just cut myself a check.
Right.
We're talking, employment check, a W-2 wage, where you have to pull out,
Yep.
and for those purposes, for those funds, yeah, that will be treated as having been paid over all year. A little bit. It's one of those weird situations where the IRS is very generous on that particular instance where you're taking the paycheck to allow it to go all the way back, because you probably earned that paycheck throughout the year. However, here with the the conversion, we don't get that treatment. It is typically treated as if it was earned throughout the year. So we'd like to get that first quarter payment in there, or do something like the technique mentioned here, doing that payroll at the end of the year. But again, it's not a guarantee. Can't promise you.
Do we want to talk about?
We can talk about the quarterlies. We didn't talk too much about it. Quarterly is just that. It's an estimated payment you make each quarter. So if you knew that this was going to happen, that later on at the end of the year you're going to do this, well, then make a larger payment at the quarters, each quarter, for that additional amount that you think you're going to convert. Elliot, I don't know 365 days ahead of time how much I want to convert in December. Well, at least you can do tax planning and get an idea.
Yeah.
And we can create a glide path for you, landing pattern for you to determine, well, we don't maybe know exactly, but maybe we have a rough idea. You can at least, make some estimated payments that are a little more accurate, knowing that this is going to go on. And that's what we do in tax planning,
Right.
is to try and make it a little bit easier for you.
Right, and I hate saying this, it sounds kind of demeaning almost, but I feel like they almost do that for your own benefit. like make estimated payments, please, because if you get to the end of the year and you got this massive tax bill, like how much more stress can you get, right? And you got to figure out where to come up with the funds. Make the estimated payments is usually going to be just in your benefit.
Yep.
Use the vouchers. You know, if we're preparing your taxes, they're going to come with voucher. You don't have to clip them and mail them in or anything, but it's going to tell you how much to pay by when, all the information, all that stuff. Pay through the IRS. You get confirmation. You know, they have a nice little readout of everything you paid. Make sure you select the right date, year.
Right year.
It gets a little tricky.
Oh, we see that all the time. Someone goes in and they pick the wrong year and the IRS applies it. Now, sometimes the IRS won't even listen to you and they'll apply it to a back year if you owe back taxes, so just be aware of that.
If they know.
But they won't, you know, you just want to be very careful to make sure you're getting the right year on there.
Right. And then similarly on this, guys, a lot more information here. When do we do a conversion? What about, you know, earnings capacity, how close we are to retirement? A lot of different factors here. How much we want to do this all comes down to tax planning. That's where we really want to detail it out. Calculate. Give you guidance that you can rely on with some, you know, with some as accurate numbers as we can come up with.
Absolutely.
Great question. Anything else? I mean, we could go into a lot more on that one.
I think, but they did a nice job of summing up.
Yeah.
The issues
Breaking
that
out all
one
the parts.
would
Yep.
pretty much look at.
Yep.
So I think we're good
Great
there.
work. Let us know if you have any follow-up on that, guys.
Questions, they already got 89 questions answered. Good job, guys.
Oh, wow. Nice.
We're moving through it. All right.
So how does tax work? So I like, yeah, good job on theming these together. I like that. Good congruency here. How does tax work if a business owner is paying himself as an employee? Do we have to tax twice, once for business income and once for employee payroll taxes? Great question. The first thing we want to talk about here is just payroll is a tax deductible expense, right? When your business pays payroll, that's a tax deduction. It's going to lower the taxable income. Unlike maybe like a dividend, the C corporation is going to earn income, then pay tax, then it will issue a dividend that you have to pay tax on a second time, you know, double taxation there. Not quite the same with payroll. That's a deduction to the company. You have to pay your payroll taxes, your employer or you pay in your payroll taxes as well.
I think something that gets confused here a lot is I'm an employee of my business. Well, many would think that, okay, I'm a sole proprietorship. I just do Schedule C. Am I an employee? No, you're not considered an employee. All your income is considered your earnings, but we don't call you employee, so you don't set up payroll for that. 100% of it subject to employment tax and income taxes, et cetera. So we have no payroll there in a sole proprietorship, so we don't have to worry about being an employee there. Partnership, really, partners are not considered employees unless it's favorable to the U.S. government. There are certain types of times where they actually consider partners employees, but for our purposes of being considered an actual employee, you are not an employee of your partnership either. The money flows through you via K-1. S corporation. Now all of a sudden we got something different. It's a corp. It's a separate reporting instrument. It has a little bit of a corporation aspect to it, thus the name S-Corp. And it does require reasonable wage. That's going to be an employee. You're paying yourself that reasonable wage. And how do we calculate that reasonable wage?
Yes,
S-Corp?
reasonable wage, kind of a three-prong approach, I guess. One is this very wide range, 30 to 50 or 60% of net income. That's not going to help you too much. That like I said, a very, very wide range. Gives you a place to start. Second part of that, and 2 and 3 are very closely related. If I went on Glassdoor or Indeed.com or something like that and found, you know, XYZ description of a property manager, how much are they getting paid? That'd be kind of my replacement salary. And again, closely related, pretty much the same kind of thing. How much would I have to pay to have somebody just replace me to do my job, right? Maybe the distinction would be one's kind of an industry average and one's kind of more based on the particular job functions that I'm doing, how much it would cost to replace me. So that's our reasonable wage. Now, we have this range. If we, very generally speaking, if the less we pay ourselves, the less payroll taxes we're going to owe. The more we pay ourselves, the more could be eligible to contribute to a qualified retirement plan if that's our goal, right? Of course, this has to be in a reasonable range based on services provided, all that good stuff. But then we want to look at our planning aspect as well, right? Where are we headed? Are we trying to just lower taxes, cut taxes down to nothing? Or are we trying to pad out $70,000 plus a year over to a solo 401k? Those are very different goals, so it depends on kind of where we're headed.
Right, and then of course outside the S corporation we have a C corporation. What if I have my own C corporation? Yeah, you're an employee there as well, so you're just going to do payroll, straight payroll like you're working for anybody else. How does this all come down to how it's taxed? Well, again, if you're a sole proprietor, all that just flows through to you. There's no payroll, so we only get taxed once on our 1040 return, our individual return for those funds. Partnership, very similar. It does file its own return. And each partner gets a K-1 that represents their portion of the earnings, but it only gets taxed once when that K-1 hits their personal return.
Right.
And so therefore, again, only one time we're being taxed there, and that money just flows through, just like the sole proprietorship. S-corporation, it's kind of a hybrid. As you so well put, you're going to get the income there, the reasonable wage. That's going to be payroll. You're going to pay payroll taxes and everything on that, and it hits your 1040. You'll pay income taxes, but it's payroll. So the S corporation gets a deduction. So if we have an S corporation, we pay Barley $100,000 or something like that. The company gets a deduction for that amount. That amount only gets taxed on his personal return. All right. The rest of it is flow through, and it'll only be taxed on his 1040. Any of the dividend part or anything coming out from that's not, or everything that's not W-2 income on an S corporation will just flow through to him on a K-1. Distribution, that's the word, thank you.
Kind of misleading, whether you take it or not. It's called a distribution.
Exactly, whether you distribute or not. And then the C corporation, again, it's completely separate taxpayer. Again, it pays salary to Barley. That's a deduction, so it's only going to get, you're going to get taxed only once again on Barley's on his 1040 when he puts his W-2 income. So there's no double taxation going on any of that. The business does get a deduction in those cases. In no case that I can think of would it be double taxed.
Yeah, and now remember, one of the powerful aspects of this is that you're both the employer and employee. So we can max out both sides of that calculation, right? Knowing it all figuratively ends up in your pocket at the end of the year, so to speak.
Tax planning.
Anyway. Yep.
That's
there you
tax
go.
planning.
That's tax planning.
Right there.
All right, let's go to this is kind of a fun little change of gears here. How do I do a 1031 exchange? A 1031 exchange, like-kind exchange. We used to be able to do that with business assets maybe way back in the day, but this is only related to real estate now, right?
Right.
So 1031 exchange, like-kind exchange, that used to be a much more general term. You'll see this form 82, 84, or something like that for your like-kind exchanges. Used to be a very general term. I could exchange this type of asset for that type of asset. Now it's just related to real estate. Was this a Tax Cut Jobs Act thing maybe?
It was, yes. Yeah.
So how do I do a 1031 exchange? Let's start with what is a 1031 exchange. This is I have a piece of real estate used in business. This is not for personal property or personal use real estate. A piece of real estate used in business, and I want to exchange it for another piece of real estate also used in business. That's a 1031 exchange. Essentially what we're trying to do is defer the gain and then get an adjusted basis in the new asset. And we can, is Ross in the chat today? Ross is in here. Ross is in here. I love using Ross's phrase, 1031 to, what does he say, till death.
Right,
I like to say 1031 for life. But Ross has
1031 till you die.
That's right. Ross has a little more morbid. 1031 till you die. But that's kind of the Donald Trump strategy, if you will, right? You're going to keep increasing your assets, and then what was that term? Stepped up basis, right? When you pass, your living trust assumes ownership of everything, and your heirs get it stepped up to today's fair market value. A little off topic there, but these are closely related strategies. You don't ever have to sell real estate. You can just use it for its advantages and keep building the asset value of your overall portfolio. So let's hop right in. How do I do a 1031 exchange? What's my first? Where do we start?
Well, first of all, again, you're trying to defer tax. So let's say we have a rental. We've had it for 27 and a half years. We've fully depreciated the thing or something like that. I don't want to sell it because I'd pay 100% tax on everything, every dollar that came in. There'd be no basis to take against it. So I want to maybe get another bigger piece of property. I've made so much cash on this one. That's called the relinquished property. I have to go out and I have to buy another property called the replacement property. Now I need to do this within some time frames. Within 45 days, I have to determine what property I'm going to pick up. The replacement property, I have to list it out. I have to let the government know. If I go literally 1 minute over midnight in that particular time zone, it'll be too late after 45 days. They're very, very tight on these rules. Then I have the remainder up to 180 days. So
to actually close.
Yeah, 135, another 135 days to actually get all the closing done. So I sell a property, all this has to be done through a qualified intermediary. You cannot touch the cash. So you're going to go to a third party that's kind of, just sitting there as a banker, if you will. They're going to take the cash from the sale of your property. They're going to send it out, buy that replacement property, all within the time frame. So they'll try and keep you on track, make sure everything's moving forward, and so on and so forth. Now, you get that replacement property as long as the property you bought costs more than the value of what you sold. So let's say you sold it for $100. You have to buy that new property, the replacement property, for $100 or more. Let's say there was some debt left on that property, $20 of debt. You have to pick up at least $20 or more of debt. As long as you do those two things, you'll typically defer all the taxes, and you're not going to have to pay any at that point. That's a big goal to be aware of. How much are you going to defer? You want to make sure you can defer all of it. Some people say, no, Elliot, I only want to defer 90% of the tax liability. So that's where you get into tax planning and things like that. But in this case, that will give you full deferment. Now, the big question is, once you do all that and you do the 1031, you pick up the replacement property, that is now yours. The QI signs off on everything. You take over the property and continue renting it out. And that's a 1031. It's a like-kind exchange. There are more significant rules with, it's how many properties you pick up and everything like that. You can pick up to 3 properties in exchange, or you can pick up an unlimited amount of properties as long as it doesn't go over 200% of the value of the property you got rid of. So those are some of the rules on how many properties.
Right. So you can have a couple extra. So if you go 1 minute over minute, so you don't have to jeopardize your whole exchange if one of the transactions falls through.
Yeah, and we got our next question actually goes in far more detail, so we'll hit that here, just coupling off what we just answered. So how do I maximize the property depreciation after I do a 1031? Am I stuck with the previous depreciation rate and amount of the previous property?
Good question.
So let's change it up, and let's say we didn't fully depreciate it all. There's still a little bit of depreciation in our property we gave up. It's called carryover. That basis is going to carry over. You take that same amount. Let's say there was $10,000 that we had not depreciated. That becomes the basis in our new property. Wait, I just bought a new one for $200. I didn't get $200. No, because remember you had to defer the taxes. And so what's really going to happen? The calculation for the basis is going to be
a lot of fun,
right? It's going to be the sales price of the property you purchased, the replacement property, minus the deferred gain. Okay, that's it right there. So you take the amount you paid for the new property, subtract out your gain that got deferred. That's going to be your basis in the new property. Now, to determine that deferred gain, all of a sudden now we're getting to what we've been hitting all day, basis and things like that. To determine our deferred gain, you take the sales price of the property you gave up. Let's say we sold it for $100. We had $10 of basis left. That leaves us with $90 of adjusted basis. If we didn't do anything, that's our gain. And again, if we meet those two criteria, if we bought more expensive and we picked up more debt, we fully deferred then. So in our case, all $90 got deferred. That will be part of our basis to help determine the sales price minus our $90 deferred. That becomes our basis in the new property. How do we depreciate that $90? You got some options. You can continue doing the same thing you did on that first property. In other words, we had depreciated down to $10. We'd had it maybe 20 years. What's 27.5-year property? You can continue just taking that amount and doing it over the rest of the 7.5 years at $10. And then the new stuff, anything additional that you picked up, you can start over at 27.5, or you can elect to call all of it and brand new and just do it at 27.5. So you have some options there. One might have a better play for you in a particular year than another. So it's one of those things, again, you want to calculate, come in and have some tax planning. But how do we maximize? Well, the way you maximize is just buy more.
Trade up.
Exactly,
Yeah.
trade up. The more you trade up, the more depreciation you're going to have to work with. Are you stuck with the previous depreciation rate? In a sense, yes. It's either that or you start over at 27 if you decide to combine all the assets. So those are your two options there.
Boy.
Yeah, there's a lot to it.
Proud of you guys.
Yeah.
That's a big one. Well, that 1031 exchange worksheet can be super complicated. But yeah, I've realized that sales price minus your deferred, that's going to be your adjusted price carrying forward. Yeah, I guess that's right.
Yeah, but that's how you do it.
That's how you do it. Well, let us
So-
know if you have any questions on that, guys. Yeah.
Yeah, again, speaking of questions, we now got 124, so as we're kind of tying it up here.
Speaking of
again,
questions.
Thanks to Troy, Arash, Dutch,
Only 3
Jared,
open. Yeah, thanks,
Jeffrey,
team.
Marie, Rachel, Ross.
Yep.
Thanks to the guys in the back making everything happen.
Yeah, our IT
And I think we got
studio
Amanda
team.
on YouTube. I think she's out there too, I believe.
Nice.
So,
Was that our last one?
that was our last one.
Wow, good work, guys. Well, I guess that wasn't too bad, was it? Well, just as a reminder, guys, we are here every other week. So let's do a quick, we got the YouTube channels, we got some announcements to make, but let's go over the services real quick, just to reiterate here again, guys. So Tax Tuesdays every other Tuesday, going over your questions that you submit. Platinum Portal questions, please submit written questions. Usually can get back to you within 2 to 3 days. The Platinum Knowledge Room, 5 days a week, 5 hours a day. Please consider this like you have a professional services team on call, at your beck and call, on demand. 5 hours a day, 5 days a week, staffed by CPAs, attorneys, the tax preparers, bookkeepers, the nonprofit team is in there. Again, 5 days a week, 5 hours a day, guys. Please take advantage of that service. So many ways to get your questions answered. And just to reiterate, if you do want calculations, specific guidance, we'll push you to become a tax client, set up a tax call. We can go into a lot more detail, as we mentioned.
And go ahead.
Yeah, no, that's it. That's all I
And
got.
a reminder this week, next week, next Thursday, Friday, we have something called TaxWise. That Barley and I will be.
Oh, the Tax Wise Workshop.
Yeah,
I haven't heard of that for a while.
Right? And those of you who remember, we used to do it every 2 weeks, I think it was,
That's
wasn't
right.
it? Yeah, well, we've condensed it down into quarters. We're going to do it every quarter. So we'll be starting up next Thursday. It's going to be all day Thursday, all day Friday. We're going to go through all those strategies that you know and love, except for the strategy of paying payroll at the end of the year to cover your Roth IRA conversion.
We'll just cover that as an option.
Right? That's a technique, not a strategy.
Yeah, 2-day full live virtual event, guys, TaxWise Workshop. We are going to just hit every single strategy that not every single, but the main strategies that we recommend that you've definitely heard of here at Anderson. We're just going to drill down on every single one of those 2-day live virtual event. Please join us for that.
Yeah, we're going to have some people in the background answering questions again,
Yep.
just like we do today. So we're excited to get on the road and do that again. We've been waiting.
And, of course, make sure you come to the live events, guys. Tax Tuesday, Tax and Asset Protection Workshop.
Make sure you get those questions in. I think we have a slide coming up. What's the next slide? Do we have the...
Oh, yeah, right here.
Yeah. Email them, Tax Tuesday at Anderson Advisors. I read through every one. Every one of those
He really
questions I
does.
go through. Pick out the ones that are, we got like 5 questions about this topic, so I'm going to pick one out of there that, broadly hits all the aspects of it as much as I can. And or come to our website, andersonadvisors.com, check us out. And thank you so much for joining us and bringing those questions in. We greatly appreciate it.
Yep. Good work today, guys. Here, we'll give you the clap track.
Yeah. It's all you.
All right, guys. Submit your questions. We'll see you next time. Thank you so much for tuning in, and we really appreciate your business and look forward to seeing you again soon.